Good afternoon, everybody, and welcome to the Urban's Housing Finance Policy Center's third seminar on the considerations for privatization of the GSEs, Fannie Mae and Freddie Mac. We have a terrific lineup today, but first, some housekeeping I need to go through. And by the way, in case you missed the other two seminars, we'll post the links to those so you can review those. But first, let's get the housekeeping out of the way. This event is being recorded. We'll post a recording online afterwards so you can view it and share it. We won't give a lot of details about the speaker biographies. Most of our speakers today should be known to all of you, but if you want to read more about them, you'll be able to find it at the urban.org online. All participants will be muted, and we invite you to type your questions and comments into the Q&A box at any time. So without further ado, I will now turn this over to our host and moderator, Lori Goodman.
Well, thank you all so much for joining us today, and a special thank you to our distinguished panelists who I'll introduce in just a second. In all the discussions we've had on reform, recap, and release of the GSEs, there's been very little focus on how Fannie Mae and Freddie Mac have been reshaped by conservatorship, what they've achieved, what the constraints of conservatorship have been, and what would be the risks, costs, and benefits of their release. Yesterday's actions taken by FHFA serves as a reminder as to the uncertain direction of the enterprises going forward. There were sweeping changes made to the board of directors at Fannie Mae and Freddie Mac. At Fannie, 8 of the 13 directors were ousted. Bill Pulte will serve as chairman, and 3 additional new directors were added. The action was similar at Freddie, with 6 of 12 directors ousted. Pulte will serve as chairman, and 3 additional new directors were named. While the implications of these actions for the release from conservatorship are not obvious, it serves as a reminder that the strategic direction of these enterprises is so crucial to both the single and multifamily housing market. Thus, the discussion today could not be more timely, and I couldn't imagine a better panel of people to discuss these issues. 3 former GSE CEOs, all of whom served during conservatorship. In alphabetical order, David Brickman, the former Freddie Mac CEO from 2019 to 2021. David spent most of his career at Freddie Mac as head of multifamily before assuming the CEO role. He's now a partner at D2 Asset Management, a global investment management firm specializing in asset-based credit, as well as a non-resident fellow at the Urban Institute, and we are very happy to claim him. Hugh Frater, former Fannie Mae CEO from 2018 to 2022. He assumed the role after serving on Fannie's board of directors. He spent most of his career at BlackRock. In his post-GSE life, he's now chairman of Vessel Technologies, a company which specializes in affordable modular multifamily construction. And finally, Don Layton, former Freddie Mac CEO for 7 years, from 2012 to 2019. Most of Don's career was in banking. He started as a trainee at Manufacturers Hanover, and after several mergers, retired 29 years later from the bank, which then had become JP Morgan Chase, as vice chairman and one of its 3 top executives. He was also chairman and CEO of E-Trade Financial in 2009-2010. Post-retirement from Freddie Mac, he stayed involved part-time in housing policy, first at Harvard's Joint Center for Housing Studies, and currently as a senior fellow at NYU's Furman Center. So again, thank you all for joining us today. I couldn't imagine a more terrific panel. So for the first question, how has conservatorship changed Fannie Mae and Freddie Mac, both positively and negatively? Don, why don't we start with you on this question and then move on to Hugh and then David.
Okay. I'm going to step back and look at the big picture here. The first thing is the classic, what didn't happen? And this is really important. What didn't happen is that the GSEs did not become a highly politicized, off-budget source of spending by the politicians. There's lots of examples of lenders or insurers controlled by the government underpricing risk chronically, loose credit terms, all that kind of stuff. Things that are not consistent with safety and soundness. The pressure was on in the early years on this front on Ed DeMarco and Mel Watt, who were the FHFA heads at the time, in particular about principal forgiveness on a large scale. So kudos to them for standing up for safety and soundness, insisting that things that should be done on budget are done on budget, and things that can be done by the GSEs are separate. Second, if you look back, something happened that was never predicted. With the government in managerial control of the two GSEs, Fannie and Freddie became better commercial operating companies than they ever were before conservatorship. This was not expected. Of course, pre-conservatorship, the GSEs claimed they were great private sector companies. They even denied being subsidized. Critics, of course, said otherwise, that they actually were mainly just subsidized and making money off of subsidies. When I got to Fred, got to see what was going on, it became clear the critics were more correct than not. I came from the large, sophisticated FI world, and they were not. And subsidies had been the source of most profit. They, however, were great lobbying and political organizations because they went where the money was, and the money was protecting the weaknesses and defects in the charters and the loopholes that allowed them to earn so much profit. In conservatorship, however, those loopholes were plugged, and they had to actually focus on running good companies. The marketplace, I think, of primary market lenders realized that in 2017, and whether it's risk management with credit risk transfer, they started to see technology investments making the primary lender process cheaper, easier, and better. They saw all sorts of programs, things simple, sort of like the whole rep warrant framework everyone was very agitated about many years ago. Now, they weren't pure competitive firms because the FHFA controlled everything and they had some issues. But to me, if you look back, conservatorship has been a very good success with an outcome far better than anyone had a right to expect.
Thank you, Hugh. You're muted.
Okay. Can you hear me now? Sorry about that.
Yep,
yeah, I think Don said it very well. I think that, before conservatorship, the enterprises were under-regulated, under-managed, under-capitalized, and underpriced. And to put it, that's a reasonably succinct way to put it. And I think conservatorship has been a very, very positive thing for the enterprises. And if you look at, both Fannie and Freddie produce very good quarterly supplements. And one of the things that I always look at in Fannie supplement is the characteristics of the loan book 2008 and earlier versus the overall book and the loan book subsequently. And 2008 and earlier for Fannie in single family has a 176 basis point serious delinquency rate, and the overall portfolio has about 56 basis points. And the 2008 and earlier portfolio has about 40% FICOs below 680, and the overall book is about 7. So they're just very, very different approaches to underwriting, and I think that's been a very positive outcome of conservatorship.
Thank you, David.
So I agree completely with Don and Hugh. There have been a lot of benefits. However, I might just take a different tack and suggest I think the marginal returns to conservatorship have been declining for some time, and that there are now potentially significant benefits to reevaluating. And it's worth just highlighting some of the things that I think have more recently been kind of problematic. And in particular, I think what we witnessed is sort of a slow, steady increase in sort of the inefficiencies of the GSEs. It's not unexpected. It's a function of the complex governance environment, perhaps at times for reasons, again, that are understandable, overemphasis, multiple kind of controls and layers of management, risk management that have maybe gone beyond what is commercial to again, Don's point before, you go further back in time, there were not sufficient levels of controls. And so I think that's taken a little bit the edge off of them in terms of their commercial activities, their degree of competitiveness, their focus on serving clients, and as I know we may touch on later, the innovation that they might bring to the market. And so I do think there is a cost to the conservatorship that I think is widely felt in the market these days.
So let me ask one follow-up question, and that's, I think both Don and Hugh did a very nice job of laying out the improvements that have taken place with Fannie and Freddie with conservatorship. Is there a way to lock in some of these improvements? Anyone want to take that one?
Yeah, I'll give it a go to start. First of all, that is the $64,000 question. And lots of people commenting on conservatorship exit don't think about the next step of locking in those improvements. A few can easily be locked in. These are the underlying fundamental defects in the charters. You can have a quality capital system by the regulator, not the original tiny amount required by the charter. You can have an investment portfolio limit in one form or another, so they can't grow them like they did before to be the main profit center. But a lot of the improvements, a lot of the things that people now look at the mortgage markets and say they're better than they used to be, reflect the FHFA's heads basically using control of these two companies to make the markets better in their view. Everything about alignment, the same waterfall on working on bad loans, the same modified loans design, the requirement to do credit risk transfer certain ways. You just can go on and on about all this stuff. And those are all based on conservatorship directives. And no one really thought very hard that someday that would end. So we're going to talk about this later. You have to figure out which of those you really need to work on keeping and which of those don't. And of those that do, how do you keep them legally on a permanent basis? And you can look at the redone PSPA, you can look at regulation, but the answer is you have to do the detailed homework.
Thank you. So let's move on to what are the big risks of a conservatorship exit? And we're going to start with Hugh on this one, followed by David and then Don. Hugh, it's yours.
Sure, thanks. Well, depending on whether you're liberal or conservative, there are either one or two big risks of exit, the way I see things at least. First big risk, liberals would fear that as entities with private shareholders, the enterprises would become solely focused on shareholder return, a la Milton Friedman, and as a consequence would reduce cross-subsidies, increase prices, and this would reduce the availability of credit, especially for borrowers of more modest means. Conservatives don't mind this outcome since they view the private sector, as Don was saying earlier, as better risk managers than the public and political sector, and have always balked a bit at the social mission side of the GSEs anyway, I think. Conservatives might further think it makes no sense for the GSEs to compete with HUD to make loans to households of more modest incomes. Mm-hmm. And depending on where you sit in the political spectrum, you will view this as a significant risk to their mission or not. There are some mitigants to this first risk, which I think we'll address in a moment. The second big risk, regardless of whether you're liberal or conservative, you would view as an increase in mortgage rates caused by exit as a hard political pill to swallow, since housing costs were already at or near all-time highs. The middle and upper middle class, who form the vast majority of home buyers and mortgagees, are all voters. And of course, increases would be especially tough on lower and moderate income households. There'll be a fear that in order to generate adequate returns, to attract capital, the enterprises will need to raise guarantee fees to reach the required return on equity, and that this will curtail access to mortgage credit. Personally, I think this fear is way overblown for several reasons. First, you could mitigate the need for any G fee increase by lowering expenses at the enterprises. If you looked at the enterprise's expense base relative to their overall book, and that expense base is about half fees that go to the government and half the enterprise's expenses, it's around 16 basis points. So I actually think there's quite a bit of opportunity in there somewhere. Secondly, and practically speaking, the G fee that the GSEs control is a really, really small percentage of the cost of owning a home. And further, any reasonable G increase that's been bandied about, people have said things like 10 basis points or whatever it might be, is well inside the monthly volatility of the 10-year Treasury. And it's really the 10-year that affects mortgage rates. So by itself, any G fee increase is unlikely to change mortgage rates or access to mortgage credit and will not have any effect at all on the most important feature of the mortgage-backed securities market, which is its liquidity. For comparison, the daily trading volume of MBS, because of its fungibility, as Don was describing earlier, the daily trading volume of MBS is almost 3 times that of U.S. corporate bonds. It's 50% more than all non-U.S. government debt, a little less than a third of U.S. Treasuries, which is by far the most liquid market globally. It's actually more than 100 times the daily trading volume of the private label securities market, which at one point was supposed to disintermediate it. I admit that liquidity is the known unknown, but I personally believe the trading volume of agency MBS will either remain the same or even go up post-exit. As a consequence, mortgage rates, I think, are unlikely to be changed much, if at all, by exit. From an MBS investor's point of view, post-exit, they would have every single protection they had before exit, plus more private loss-bearing capital, which would reduce what little residual credit risk they still have. And in that analysis, spread shouldn't change much. Now, I acknowledge I've made the important and simplifying assumption that the enterprises exit with enough capital, enough regulation, and other support to avoid ratings downgrade, which would raise spreads on both agency, MBS, and debentures. So that's obviously an important factor. I will defer to David and Don on the risk of everything good unwinding.
So I might just paraphrase a little bit, agree with much of what you said. Look, these are two very complex organizations working in a complex market. I mean, and it's working very well right now, right? So you just kind of start with that there is a lot more downside than upside here in terms of the functioning of the mortgage market. There's other things we can talk about in terms of the housing market, and I'll save those for a little bit later. But generally, we're working, and there's the old adage, if it ain't broke, don't fix it. Other than the potential upside in terms of the exit. So you can mess things up through an inappropriately planned and designed exit. And that's really what I would focus on. I'm not as worried about the structural issues. I think between the PSPA, between regulatory changes at the FHFA, Don touched on before, as well as the ability to adopt new rules, I think you can preserve things like affordable housing, level playing field, other things that I know are important to the industry. What I think is the bigger issue is, forgive the metaphor, but you can't really start building the house till you've designed the community. And we've got to figure out what exactly we want that future sort of housing finance ecosystem to look like. And while it's easy to talk about some of the broad strokes, there's a lot of specifics involved. Maybe I'll just highlight what I see as sort of the top 5 or 6 sort of policy issues that are still sort of, we all probably have views about, but are unresolved in terms of structurally how exactly you want to deal with them. One's a footprint. What is the appropriate footprint of the GSEs? And how much do you balance that against a need for constant market presence? Something that is generally viewed as sort of one of the core roles of the GSEs. There is their affordable housing commitments, not just the affordable goals, but their mission obligations, scorecard obligations, other ways in which they serve affordable housing, the cross subsidy. There's how they price their price mortgages, and here too, Hugh touched on that, and that ties directly to how much capital and how their pricing is regulated. There are issues related to new products and new activities that I would argue today somewhat stifle new innovation. And there's a question kind of, is there a different approach you might take there? And then lastly, there is the role of risk and portfolio management. Here, what I'm primarily thinking of is the role of credit risk transfers and the risk appetite that the GSEs have. All 5 of those issues are things that are somewhat open in terms of exactly where the GSEs in a future state might be. And think part of the process of exiting is kind of thinking through what is the right state for those. Also recognizing they're going to evolve over time, and that whatever is determined now, you need really a mechanism so that they can evolve as market conditions, as technologies, other things evolve going forward.
Yeah. interesting, David's comments, we haven't made clear here yet if we're assuming legislation is involved or it's just via administrative means.
Just assume administrative, because I assume legislative is virtually impossible.
That's what I assume. I will, just as having been there at the time, David was also, the years about 2010 to 2014 were everybody and their brother going around in circles trying to answer all David's questions with a different form of system, with the GSEs wound down, which was the Obama administration policy, and replacing them. And they went around in circles and ended up with basically nothing when they were done. So then you go into administrative reform. Well, you're stuck with the charter. You're stuck with a lot of things. And so a lot of David's questions get answered, not necessarily what you'd like, it's what exists, and you can't do much different. The question then is, between some regulation and a revised PSPA, which I'm assuming you have, but apparently not everyone does, it's what can you make happen? Otherwise, if they're released, they're private sector companies. And if the government tries to put too much stuff on them through regulation or PSPA or whatever, it starts to look like conservatorship by another means. And I'm not sure anyone's going to put any money into that for stockholder ownership. So yes, we have all those issues. So David pointed out all the issues, and I'm pointing out all the constraints your answers have to work within.
And if I may, only for a moment, I mean, I think that is the circularity that needs to be
Yeah.
solved. I'm presuming if the objective is to bring new investors, new private capital in, there is a degree to which you have to let them know, what are you buying? What do you
Correct.
get for your investment?
Oh,
And to your point, Don, maybe it is saying the status quo as we know it today, we're largely looking to stay kind of true to that, to ensure at least there's not the volatility that your investment can be wiped out and or greatly enriched as potential new political administrations come in over, you know, the lifetime of an investment, which is longer than a political cycle.
Agreed.
So let's move on to some of the specifics that that I think. Let's actually start with the in terms of the potential pitfalls. So my first set of questions is, what happens to UMBS? I mean, Hugh talked about the liquidity of the mortgage market, how it's the second most liquid market in the world behind U.S. Treasuries, which is the single most liquid market in the world. Certainly, UMBS has had a positive impact. That depends on an alignment of policy so that speeds are consistent for both GSEs. If you lose this, how do you avoid a situation in which one of the two subsidizes their G fees to remain competitive, as Freddie did for many years? How is the common securitization platform maintained? Is that at all important? And with that, let me actually start with Don on that question. And then
Okay.
David, and then Hugh.
So as a technical matter, the Common Securitization Platform, or CSS is the subsidiary name, the joint venture, is not technically required for UMBS. So these are sort of two, they seem are talked about, but they're not technically required. UMBS is a real issue. Again, if you release them conservatorship, the charter controls, it says nothing about UMBS, unless it's somehow going to be in regulation or a revised PSPA, or maybe someone can conjure up something else to put requirements on them. And regulation has to be safety and soundness related, and UMBS is not. It's a market improvement feature. So it's not obvious. They're going to have to work hard to figure out how to keep it, maybe as somehow through a revised PSPA. And I want to put a little ringer in here. The first conservatorship directive you got when you had anything that was going to be done together from Fannie and Freddie was, don't worry about antitrust. We, the conservator, give you permission to talk to each other. That will no longer be true. And it's not at all clear to me how much Fannie and Freddie can do stuff together as direct competitors because of antitrust issues. So I don't have an answer for you, Lori, other than it'd be great to keep UMBS, but someone's going to have to work really hard how to do it in a legal way. and through what mechanism, because it is not totally obvious.
Thank you. David, anything?
And I'll keep my comments short in that I largely agree. I'm not an attorney, but agree with Don. I think the way to keep it is through the PSPA. Of course, that begs the question of will you have a PSPA and do you need one? But I think that's the answer there. Obviously, you can also have rulemakings, and I'm perhaps not as concerned that you can't sort of if you will, wave the magic wand on antitrust for these two entities. But I think you do need a durable document like the PSPA that the entities rely on in order to kind of preserve that and some of the other structural enhancements.
Hugh, anything to add?
I think UMBS, it's not totally clear that it's added liquidity to the mortgage markets. I don't know that there are additional mortgage market participants that have come into the space because of UMBS, but it did remove the Freddie subsidies. So I guess that's a good thing as it relates to CSP. It was intended to be the platform that multiple additional guarantors could join and use as the plumbing for securitization markets, and that has not happened heretofore. I think that ironically, CSP, which is sort of jointly owned by the two enterprises, now you've got a single point of failure in the mortgage market, and the other thing that is interesting about it, it probably reduces or at a minimum slows down innovation. Because let's say that Freddie Mac comes to the table with a really great securities idea for the spec market. Well, what is Fannie going to do? Fannie's going to be grumpy because Freddie showed up first. They're going to slow walk it so they can catch up, and because they have to agree, they're joined at the hip. And so I don't think that was the intention, but that's the practical effect that it seems to have. So as between the two, I think UMBS seems to be here to stay. I guess it's a good thing. It'd be nice if it actually increased liquidity over time. And CSP, it did improve the plumbing. I certainly know at Fannie it did. So it's too integral to unwind, but it has had unintended effects, which so far have not been particularly positive as far as I can tell.
Thanks. So let's move on. Can you, in terms of the role of the PSPAs, let me ask this question slightly differently, and I'll start with Don, same order, Don, David, Hugh. Can you have conservatorship exit without the PSPA returning to the implicit government guarantee as in the pre-conservatorship years? Do you need the PSPA to continue? Do you need that Treasury line of credit? And if released, is there any hope of additional competitors in this market as the Treasury had hoped for in their 2019 blueprint? So with that, let me start with Don.
Okay. So when conservatorship exit via administrative means was actually developed inside the conservatorship back around 2016, 17. It was kept quiet for a lot of political reasons. It was only made public by Steve Mnuchin when he was Secretary of the Treasury. It was always assumed the PSPA would continue for administrative means for a few reasons. One, going back years to the early Obama years, up through the Trump Treasury, they made a point. Implied guarantee is a bad way to run a financial system. It leaves the beneficiary of the implied guarantee unsure of exactly what they got, and it leaves the taxpayer getting paid nothing for the risk they ended up taking. You go back and read the Treasury 2019 Mnuchin Housing Reform Plan, it says that right in there, and the notion is PSPA continues, and it's going to be, you have to pay a fee for the support, so the taxpayer benefits. So that was always assumed. I know there's a lot of loss of historic memory, but I found it very odd everyone's talking about not. I also, quite honestly, not sure the marketplace would like it, and it would, and it wouldn't have a relatively significant effect on mortgage rates, but we'll see. what we've also talked about, it was discovered you need a PSPA document as the legal mechanism to keep a lot of these improvements that were done since 2008. Otherwise, how do you do them? The current investment portfolio limits there, but anything you want to keep like UMBS or servicing alignment, you're going to have to put it somewhere. It's not all safety and soundness oriented that can fit in a regulation. So everyone figures that it was originally figured PSPA would have it. So the answer is, I think you got to keep it. As to additional competitors without legislation, zero. How can you, there's no way to enter. And even if legislation allowed it, I believe it's completely unrealistic for a lot of reasons that anyone would ever enter the market de novo. Or how it would even work. It's already hard enough to keep Fannie and Freddie's speeds together. How'd you like to be the third party in that game?
Thank you. David?
So what, you could get rid of the PSPA, certainly. I mean, you could do lots of things if you want to take tremendous risk with a well-functioning market. And you know, it's obviously something you can't know with any certainty until whether you don't do it. But I would advise strongly against it.
Yeah.
I don't think it's a good risk. I don't think it's good policy, as far as the potential downsides are fairly significant in terms of disruption of the market, and given everything is functioning reasonably well, and the potential for not just mortgage rates to go up, but further actually capital rationing in the mortgage market. So I think you need the PSPA. I think you want the PSPA. And as Don highlighted, it actually provides a very convenient legal vehicle to enshrine these structural enhancements. It now takes the place of what might have been legislation or needed legislation to cement these innovations. So I think it actually kind of serves both functions. I think you do want the GSEs to pay for the use of the PSPA, and a reasonable amount, not necessarily the existing and previous kind of dividend structures, but that were put in place, but a reasonable fee on top of the backstop. It actually starts in some ways looking like FDIC insurance. I know Don objects sometimes to that comparison, but I think it kind of almost sort of starts making the GSEs somewhat analogous to the banks. And on the issue of competitors, I agree with Don. Only I'd say, look, is there room for one more as sort of a co-op serving small community banks, perhaps, and kind of outside the UMBS? Sure. But as a real competitor that represents a major financial institution, no. There's such scale required. There's such coordination required. You'd be adding risk to the system. I don't really see what you're getting or kind of what the benefit of doing it, other than just claiming there's more competition. Though it's worth noting, for those of us who are kind of in the GSEs, the GSEs, even in conservatorship, or points in time, competed fiercely against each other. You get a fairly significant amount of competition even amongst the two. So again, I'm not sure what you're solving for by kind of wanting additional competitors.
Thank you. Hugh, anything to add?
Yeah, I think on the last point, I mean, I'd always thought that if you added a bunch of competitors to the market, all you're really doing is increasing operational risk and increasing market risk, and it never sort of made a lot of sense to me. A well-functioning Coke and Pepsi type duopoly tends to price things at the right level, and tend to avoid ruinous competition. And even though we saw it in the past, I think with the right regulatory and capital framework, you can avoid that. And I do agree with Don and David that the PSPA is it's important to maintain that for a whole variety of reasons. Even though those who argue that the implicit guarantee is fine on its own would make a few points. One is you've never had anything other than an implicit guarantee, and the implicit guarantee has been proven to be adequate on numerous occasions. And if you really don't believe in it, I mean, you have to remember that during the pandemic, we bailed out Carnival Cruise Lines. So I don't think we're going to bail out Fannie and Freddie again. But I do think it would be much better. It would be much, much better to have the PSPA in place. It would provide comfort to investors, comfort to the rating agencies. And I think you'd have a much stronger system combined with prudential regulation and strong capital rules.
Thanks very much. So, assuming the GSEs exit conservatorship without any major operational changes, which is what we're talking about with the PSPAs in place, what is their potential to better serve the market through more innovation? What products would they add, and why can't they do this now? So, if you could sort of think about this from both the single family and multifamily perspective. And with that question, let's start with David, and then Hugh, and then Don.
Sure, and I kind of alluded to this earlier. I mean, I
Yes, you
think
did.
the potential for the GSEs to contribute to more innovation in the market is probably the most compelling reason for exit. There are others as well, and I think they really can be drivers of innovation. And as I've said before, the mortgage market's functioning well. The housing market, not so much. Broadly construed, right? We have constraints on supply. We have a high cost of ownership and renting. We have a very high cost of financing, and we can talk more about that. That's obviously getting closer to home in terms of the GSEs. And I think the GSEs can contribute to all of those issues. And I think you need appropriate guardrails and constraints on their activities. We don't want to go back to them taking too much risk, but you don't want them kind of encroaching into other markets given their charters. But I think you got to start with a recognition that they have tremendous expertise. They have tremendous people who are there committed to their mission. They have infrastructure. They have resources. They really are kind of objectively the right entities to be engaging in innovation. And there are tremendous opportunities in front of them. And just to kind of touch on a few, I mean, just in the very financing process, I mean, we've seen some of this in appraisals. I think we continue to see more. We can see more in title insurance. We can see more in other parts of the underwriting technology. In terms of products on the supply side, I think construction, multifamily in particular, also single family, are areas in which they could contribute through additional loan products. However structured, I think they can help drive some of the innovation in building technology by leading in a little harder on modular housing and factory built and manufactured housing. I know Hugh knows a great deal about this and works in that arena, as well as just contributing to additional sources of new supply broadly, again, multifamily and single family. And I think the challenges for them to do in conservatorship are really just the impositions that are put on them. There's a new product rule. There's a limit on activities that they engage in that sort of limit some of their abilities. There are also no incentives in terms of the GSEs. That there's no kind of payback per se for them to engage in innovation and state some of the obvious. I mean, having private investors back in the GSEs, seeing the potential opportunities would I think both provide the capital to engage in innovation, to help commercialize, if you will, new technologies, as well as bear the risks associated with doing that. And then, part of it is just the culture of however many years are we at, almost 17 years of conservatorship, is you need to just kind of help push them back to contribute to value creation in the market is a good thing. And back even, again, I'll say during conservatorship, I mean, there used to be a framework we'd have where if you can do something in which a new an execution, new product, new initiative in which you can manage or distribute the risk, manage or distribute risk and serve the mission broadly defined in terms of liquidity, stability, affordability, and earn a reasonable return, then that means that's something that you might consider for either, again, a new product, new execution. And I think there's a lot of opportunity there. I think that's, again, the big upside from a potential exit.
Thank you. Hugh?
Well, thanks, Lori. I'd agree with everything David said. And I think that, out of conservatorship, you'd be moving from a conservator to a prudential regulator, which I think would be one which would be a change in tone, which would be useful from an innovation point of view. Personally, I'd rescind the new product rule, which I think stifles innovation. Some of the areas in which they should innovate. First and biggest, I'm sort of encouraged here by the fact that Director Pulte seems to be an avid technologist. Most of the requirements of the mortgage market are determined by lenders. of which the biggest are the enterprises. By using their data enabled by agentic AI, they could lead the charge to dramatically reduce the frictional cost of obtaining, originating, and servicing a single-family mortgage loan by expanding the use of cash flow underwriting, smart contracts, tokenization of borrower data or loan data, property information. This could save consumers money and make housing more affordable. Second, David referenced this. The biggest issue we really have in housing is not the lack of subsidized credit for homeowners, but the lack of attainable supply. Residential construction has lagged every other industrial sector in productivity for 50 years.
Yep.
I think the GSEs can be an important part of the solution by helping lower the cost of capital for manufactured and prefabricated housing, whether it be single or multifamily, and thereby increase the supply of housing. In the same vein, they could use their influence as big participants in the multifamily tax credit market and the housing bond markets to promote efficiency in those programs to produce more rental units per dollar of subsidy. And third is another way to increase supply. I think they should evaluate and pilot assumable mortgages as a way to release single-family inventory that's locked up at 4% or lower rates than originated during the pandemic. All these things can be done, and some have already been piloted, but due to the kind of natural friction of bureaucracy, concerns about political fallout, lack of bandwidth and/or courage at the organizations themselves, not a lot of this has been pursued vigorously. And some of these innovations we have to remember, and this is just the world we live in, might be controversial to the mortgage industry writ large. But I think we have to remember that these are mission-driven organizations. That's embodied in the charter. They are not, nor should they be, tools of industry. Their key customers are homeowners, renters, and taxpayers, and not, with no offense intended to anyone, mortgage bankers, realtors, real estate attorneys, title companies, appraisers, mortgage software providers, mortgage insurers, et cetera, et cetera, et cetera. So I think there's a terrific opportunity out of conservatorship to innovate for the betterment of the market, for the betterment of their constituents, and for the betterment of all of us.
Thanks. Don, anything to add there?
I'm going to do a bit of a downer.
We counted on you for that role in this question.
Yeah,
unusual.
I tell
It's
you,
very unexpected.
I get more negative as I get older. The upside has been mentioned by David and you. It's great. But pre-2008, that was not the life. It was politics and lobbying and loopholes. The whole concept of a GSE is weird. It is give them a charter, some obligations, some restrictions, some subsidies, and with that, acting as a for-profit maximizing private sector company, they'll do a social good. That is a really tough balance to get. They failed with the two GSEs for Fannie and Freddie originally, and to introduce a separate topic, the home loan banks show the same problem where they end up being mainly about loopholes and things like that to make money, not so much the mission. So it's how do you prevent the backsliding? That is the big issue. I think there'd be momentum, cultural momentum for the first few years, but if you're talking over 10 and 20 years, that's a real issue to me.
Thank you very much. So with that, let's move on to some of the nuts and bolts on how might a successful recapitalization work. Is it feasible? How long might it take? Are there necessary conditions that would need to be met in order to raise new capital? And Hugh, we'll go to you, and then Don, and then David on that one.
Thanks, Lori. So to successfully recapitalize, there are a lot of conditions that should be met. I'd bucket them into several categories in no special order, since in my mind, they're all important. First, a sustainable go-forward business and regulatory model that investors can believe in. Second, maintain market confidence in the go-forward liquidity of the mortgage-backed securities market. And third, a rationalized capital structure that can accommodate new private capital. As we've discussed, all the above need to be accomplished without significant upward pressure on mortgage rates. And as required by the latest amendment to the PSPA, this all needs to be done with some public input and can only be done with Treasury's consent. In the first bucket, the enterprises need to have a business model that private investors can have confidence in. What space do the GSEs naturally occupy in the mortgage market? And in that space, can they produce competitive returns through business cycles? When I say that, I'm thinking kind of low double digits initially, but without being pressured to take excessive risk or inadequate price by regulatory and political interference. To reduce the risk of political interference, I think you need to evolve to a from a conservative to a strong prudential regulator. It doesn't mean there can't be political influence, but I think that's going to be really important for investors to have confidence in. And respect to their rightful space in the market, they generally fit between FHA and the banks in the private label market. They generally acquire medium-sized loans to middle class and upper middle class borrowers who represent the majority of mortgagees. Their moat, which we've discussed a few times, is the well-established liquidity of the MBS market, which new entrants would be very hard-pressed to replicate. They'd eventually become dividend-paying utility-type equities that could grow with the overall housing and mortgage market. The second bucket, most important constituency by far in this whole discussion, at least in my opinion, are the global mortgage-backed securities investors. The genius of the U.S. mortgage market, of course, is getting investors around the world to take interest rate and prepayment risk and a little bit of credit risk to fund our housing market, such that the only securities market more liquid, as we discussed before, is the U.S. Treasury market. This is, the liquidity is what keeps mortgage rates low, and it's investors' belief in the implicit guarantee, combined with decades of transaction volume that maintains it, plus some of the additional protections we've discussed. We've got to maintain that liquidity upon exit. We've got to maintain the ratings. And I believe it's all about capital and the PSPA to provide some amount of additional explicit credit risk protection for MBS investors. Now, that's an addition. People sometimes forget this. What they already have from borrower equity, mortgage insurance, credit risk transfer, and of course, the implicit guarantee. But I think that there are some granular things you need to do, like make sure that under FICC, MBS can still be used as collateral with the right haircuts and capital charges in the repo markets. So that's going to be important as well. And the third and finally, in the third bucket, you need investors to be able to invest in a capital structure that will ultimately have adequate float in the public markets and without the government as your perpetual majority shareholder. Rational capital structure to me means both a robust level of loss-bearing capital to provide assurance to the debt markets and an equity capital stack that's cleaned up in some fashion the overhang of both the Treasury's senior preferred position and its warrant position. Stated amount of Treasury senior preferred in the enterprises does not count as regulatory capital. And in addition, it has growing liquidation preference. It goes up with earnings. This obviously has to be addressed. Depending on who you listen to, the process for exit could begin very soon, and in some ways has already begun. The enterprises are already publicly traded, SEC reporting, SOX-compliant entities, and so have all the reporting capabilities in place. What is needed is the resolution of the issues that we've raised, as well as input from the relevant stakeholders. From all I've heard, Director Pulte and Secretary Bessent, the two key players, along with the President, of course, are extremely sharp folks who will be very thoughtful and mindful of all the exit risks that we've spent the day discussing.
Thank you. Don?
So if you didn't make it sound as complicated as possible already with all those criteria, I got involved in two large $1 billion plus equity underwritings for FIs over the years as a principal. David originally said it. What if you want to do a recap that requires public market issuance of primary equity, meaning equity to go into the companies to build their capital ratios? It could be quite a job and quite a while to figure out what you're actually buying. You don't know the business model completely. If they're paying for the PSPA support, what fee are they paying? Is it $100 million a year or $5 billion a year? You have no idea. There's so many of these. And the old rule in the equity markets is you needed to run with this stuff for 3 years so investors had comfort. You can raise the equity, but if you raise it at a discount, that trips use requirement that you don't raise the cost of capital to push G fees up. So on top of it, I'm not sure how good you feel about investing in a company primary when behind you is the US Treasury selling 79.9% and maybe more of the company right after you. That kind of squashes the upside potential. So my personal view here is you may be better off just using retained earnings to build up the primary capital to where you need to be. People can reference today's current regulatory capital system, but that was widely criticized as too high over many years in its way, like it was too low prior to conservatorship. And then just let the Treasury have a clear market to sell its stuff secondary later, and you don't have to go through all this proving to the investor to do a giant equity issue. And I note how giant the equity issue should be. We're talking about multiples of the largest equity issue ever done in the world, which I think was $25 billion.
It was
So,
Alibaba, I think.
Yeah.
yep, Alibaba. And guess what? The GSEs are not Alibaba.
Aramco.
And,
Aramco, Saudi Aramco, yes, right.
yeah, a little bit high. And by the way, there are two companies. I haven't even contemplated the notion of doing one first and another second, or how that would work. So I think it's good that both Besant and Pulte have said you have to be thoughtful and do your homework on all this and don't expect something super quick. And I think that applies in spades to this topic.
David?
Not a lot to add. I think you did an excellent job kind of summarizing the issues, and Don as well, in terms of these challenges. I mean, I probably err more on the side of thinking, I think there is value to trying to start the process, but recognizing this is a 5 to 10 year process, and it isn't going to be sort of one big bang, one IPO. And indeed, I mean, I won't go into the financial engineering of it. I know and I think Hugh and his team at Fannie at the time, developed some plans as to how you might actually approach that, and hope, the current administration and leadership at both GSEs may look at those options, but recognizing that you've got to have mechanisms in place through this recapitalization process to help refine the governance, to help refine these rules that are going to define, to Don's point, it takes 3 years. Things will change over the process of recapitalizing and be able to adjust. And that's got to survive different administrations, different potentially different FHFA directors. And so I think it's designing a process and a roadmap as much as sort of a single, design for each of the GSEs, and beginning to just kind of have private investment come in some form, though not necessarily through through an IPO.
So let's go to the other extreme. If the GSEs remain in conservatorship for the indefinite future, what is the impact on the mortgage market? What would you expect to change over time? And is there anything that could be done to make indefinite conservatorship work better? We have about 7 minutes left on this panel, so probably not going to get to audience Q&A, but I think this last question is important. Assuming we remain in conservatorship for the indefinite future, how do we make it work better? Why don't we do David, then Don, then Hugh on this question?
Sure, and I'll be brief, and I think I've touched a little bit on. It's not the end of the world if they remain in conservatorship, but I think it's not ideal. And I've used the phrase before. I think we see a slow, steady HUDification of the GSEs if they remain in conservatorship, as far as kind of being a little bit more government-like than commercial. There are things, if that should be the case, that I think you could implement to make it work a little bit better. And these are not there's no rocket science here. I think one of the things, and there's a structural flaw in the original design of conservatorship, which is the conservator is the regulator. And I think there might be some thought to breaking the conservator off, trying to create a little bit more independence from the regulatory activities of FHFA, and trying to bring a little bit more of the voice of the market or the customers, both markets, I guess, both investor markets and lender markets, into the GSEs, considering advisory boards or something like that, elected advisory boards, perhaps. There are ways to just try to get a little bit more direct input into the activities of the GSEs. If they are remaining in conservatorship, they would just make them a little more oriented towards the market, absent having a profit-motivated investor sort of pushing on them. And I think that's, those are all possible things, but I think the preferable outcome is indeed starting the journey I mentioned before in terms of a recapitalization.
Don?
Yeah, Lori. So I prepared these notes obviously before yesterday. And the first thing I listed is the biggest negative of continuing conservatorship is being subject too much to who is FHFA director. And that's just been proven. A company that gets bounced around, I'll say every 4 years now that the director is a presidential appointee at presidential pleasure, is a real issue. Semi-humorously, I'll talk about the CEO turnover because of the low compensation. Is something that is seriously you're having, other than my time when it was early days, it's been kind of 3 years, 3 years, 3 years, 3 years as people kind of do a commitment and then they leave. That's not particularly good either. I agree with David that I think it is inevitable over the long term what he called the increasing HUDization. It's just slowly, every year, a little more control at the FHFA, a little more decision-making at the FHFA, a little bit less at the companies, a little bit less motivation to do things, to work there. It's not as exciting. So now, given all that, everybody and their brother said in 2012, 13, 14, 15, conservatorship can't last forever. We have to get to it. And so far, it's doing a pretty good job of lasting forever. But it is slowly maybe being problematic. So I don't consider it urgent, but you may regret it in the long run. The best outcome, as David said, is get going on the process. It's not a 5-minute process to exit. It's a long road. And they've gone down the path, by the way. Kudos to Mnuchin for retained earnings. That was a big step. Time for a few more steps. I would be happy with a few more steps.
Hugh?
Yeah, I don't have anything to add. I mean, when I first saw the question, what could be done to make the indefinite conservatorship work?
That was
work
actually what
better?
I was really wondering about, is what can make it work better.
Yeah, I mean, my answer is don't make it indefinite.
Yeah.
Maybe we do have time for one very quick question. Don mentioned the tension between mission and conflict. And after release from conservatorship, how do you ensure the GSEs remain focused on their mission and their innovations?
I'll throw it out there. I mean, again, it's not new. It's one of the criteria that, I mean, I'm not thinking that you wouldn't continue to have, as part of prudential regulation, the regulator approving any new products or executions. And one of the criteria to judge any new product or execution I believe, would have to be that you are serving the mission in some way, unless it's a pure risk management. I mean, there are, CRT-like innovations that could take place that probably wouldn't have the same standard. But that just becomes part of again, you need to check that box if you want to get that the new product approved.
So with that, our session comes to an end. Thank you all very much for joining. A special thanks to our wonderful panelists, David, Hugh, and Don. You guys were fabulous. And for those of you who are on the line, please fill out the survey if you could. Really, again, really very appreciative to our wonderful panelists. Thanks for putting yourself out there on this one.
Thanks, Laurie.
Thanks a lot. See you.
Take care.